Let's break down the scenarios based on the example provided. 1. In the money, ITM. Situation. The current market price of the land is $1.1 million, but the buyer holds a call option with a strike price of $1 million. Explanation. In this case, the option is in the money because the current market price exceeds the strike price. The buyer can exercise the option to buy the land at $1 million, which is below the current market value, resulting in a profit. Financial outcome. The buyer exercises the option, purchases the land for $1 million, and immediately sells it at the market price of $1 million, realizing a profit of $100,000 minus the $10,000 premium paid. Number 2. Out of the money. Situation. The current market price of the land is $900,000, below the strike price of $1 million specified in the call option contract. Explanation. In this scenario, the option is out of the money because the market price is below the strike price. As a result, there is no incentive for the buyer to exercise the option since they can purchase the land for less in the open market. Financial outcome. The buyer decides not to exercise the option, as it would result in buying the land at a higher price than its current market value. Thus, the $10,000 premium paid remains with the seller, and the option expires worthless. 3. Money TM. Situation. The current market price of the land is exactly $1 million, equal to the strike price of the call option. Explanation. In this scenario, the option is at the money because the market price aligns with the strike price. The decision to exercise the option depends on various factors, such as the cost of the premium, potential future market movements, and the buyer's investment strategy. Financial outcome. The buyer evaluates the situation and decides whether exercising the option is economically beneficial. If they choose to exercise, they would buy the land at the strike price, but if they opt not to, the premium paid remains with the seller and the option expires.